Hello, everyone. Welcome to the June episode of First Look ETF. I'm Stephanie Stanton with ETF Guide. It is great to have you with us. Coming up on today's show, we'll examine a new municipal bond ETF for investors seeking shelter from taxes, plus an innovative fund that taps into the power of artificial intelligence. And we'll tell you about a new ETF providing exposure to commodities. But first, as always, we begin with a quick recap of new ETF launches on the New York Stock Exchange. Joining us is a familiar face, Douglas Yones, live from the NYSE. Hi, Douglas. It's great to see you.
Hi, Stephanie. It's great to be back. I can't believe it's summer.
I know, right? Let's dive right into the latest launch activity.
Yeah, look, May was super busy here for us at the New York Stock Exchange. 37 brand new ETFs launched, bringing with them over $1 billion in new net cash flow. I mean, year to date, who's tracking? We are 156 brand new ETFs launched this year, bringing in $9.4 billion to this industry. We continue to grow. We continue to see a lot of innovation. It's a very exciting time.
Yeah, exciting indeed. One of the big trends that we've discussed on previous episodes is the expansion of actively managed ETFs, which continue to grow both asset and market share. Tell us more about it.
Yeah, I mean, if we look at the active ETF industry right now, you have 1,049 ETFs with $391 billion. Year to date, though, the growth has been phenomenal. About a third of all net cash flow this year has gone into actively managed ETFs. We continue a 3-year trend of more actively managed ETFs are launching every single year than passive. $144 billion in cash flow year to date in active. So you're going to hear about it in today's show. All three of our spotlighted ETFs are all actively managed. And so we're seeing both the issuer side, but more importantly, the investor side continue to seek solutions that use actively managed ETFs.
Yeah, indeed. Well, before we let you go, are there any other trends that you're tracking?
Yeah, I mean, if you look at the ETF industry now, there's $7 trillion listed in the United States. There's well over 3,148 ETFs themselves launched. But look, it's still about innovation. We're seeing it, we're feeling it, and today's show is going to be no exception. We're continuing to see, as I mentioned, active management, income solutions. There's these tremendous advances in AI. Guess what? Innovative solutions that are using AI for ETFs. And of course, the commodity scene, it has been active for the last couple of years. No change now, and you're going to hear all about it in today's show.
Yeah, indeed. We've got a great show coming up. Douglas, thank you so much. We'll let you go. We'll see you next time.
Thanks, Stephanie.
And just a quick reminder that you can now watch First Look ETF on Amazon Fire TV and Roku, so be sure to check us out there. Also, we simulcast First Look ETF at iTunes, Spotify, Amazon Music, and other major podcasting platforms. Don't miss it. The Federal Reserve's aggressive rate hikes have upended the bond market. Yields are much higher, and tax-free municipal bonds have been lifted. Well, here to discuss a new ETF linked to municipal bonds is Ignacio Canto, President and Portfolio Manager at X Square Capital. Hi, Ignacio. Welcome to the show.
Thank you, Stephanie. How are you?
I am doing very well. The fixed income landscape has dramatically changed from just a few years ago, as you know, and municipal bonds are part of that landscape. What is different now versus then, and how have municipal bonds been helped?
Yeah, so finally, municipal bonds are back in vogue because now they carry true yield. And we just launched the first triple tax exempt municipal bond ETF, which is exempt from state, city, state, and federal taxes. And this ETF beats any other municipal bond market ETF by at least 2% of dividend yield.
Okay, tax-free. You've definitely piqued my interest. You just mentioned it, the X Square Municipal Income Tax-Free ETF. That ticker is ZTAX. How does this fund work? How is it tax-free? And what types of investments does it hold?
So this ETF basically brings out exposure to the only three issuers in the municipal bond market that can provide triple tax exempt securities. That is Puerto Rico, Guam, and the Virgin Islands. So these U.S. territories have been vested with the benefit of issuing triple tax exempt municipal securities. And the interesting thing about this is that Puerto Rico is just exiting a 7-year restructuring bankruptcy process. So the credit has been significantly de-risked. It has been totally delevered. The economy is in a significant upswing, helped by about $90 billion worth of federal funds to help for the reconstruction and recovery. after two significant natural events, Hurricane Maria and 2020 earthquakes. That's about, just to give you guys an idea, 100% worth of GDP. So Puerto Rico is in a recovery upswing. The credit, it's basically a totally new restructured by the federal court system credit that we think offers tremendous value, and it's totally underpriced at this point.
How has this been received? Do you see a lot of interest, people wanting to invest in Puerto Rico?
Certainly, we're starting to see a lot of interest coming in from U.S.-based municipal bond investors, a lot of retail interest. There's also interest because those municipal securities right now are not marginable, are not repoable. But if you swap them out for an ETF, then they become marginable. They can trade intraday much easier for retail investors as well as institutional money managers. And we have been very pleased with the way this ETF has been trading. It has been tracking the underlying NAV of the basket extremely well by somewhere between 10 and 15 cents on a daily basis. So this is the most efficient vehicle out there to achieve exposure to these attractive triple tax exempt municipal bond securities.
And how do you envision a fund like Z-Tax being deployed inside a diversified portfolio?
Absolutely. Well, this is the perfect ETF to improve and increase the after-tax yield of any portfolio. Just to give you an idea, the after-tax equivalent yield of Z-Tax is almost 7% right now. The triple tax exempt yield tops 5% at these market prices. So it's an extremely attractive ETF to enhance the yield of any fixed income portfolio, to further diversify the credit as well. It's, again, a very mispriced, very cheap credit that offers tremendous value just because it's exiting a 7-year bankruptcy process.
Well, you had me at tax-free. Ignacio Canto, thank you so much for joining us.
Thank you for having us, Stephanie.
Artificial intelligence, also known as AI, is a big deal. Consulting firm PwC says that AI could contribute up to $15 trillion to the global economy. That's more than the current output of China and India combined. AI is also reshaping the investment landscape. And joining us to discuss a new ETF that taps into the power of AI is Francis Gisock, Asia Pacific CEO at QRAFT Technologies. Hi, Francis. Thanks for being with us.
Hi, Stephanie. Thanks for having me.
So artificial intelligence, we all know it as AI. It's becoming more prevalent and immersed in business everywhere. How is AI radically changing the way business gets done?
AI is definitely the big deal this year, 2023. After we are seeing the emergence of the ChatGPT or the other large language models around us, it totally changing our day-to-day life from the this could be the enormous changes in terms of how the AI or the new technology can be effectively bring a more productivity in our day-to-day life. And we are the QRAFT Technologies. We are the one of the forefront of the company trying to apply the AI into the investment spaces since 2016.
Also, I want to give you a special thanks for joining us. I know it's the middle of the night where you are in Hong Kong, so you get an extra thanks for that.
My honor.
All right, so your firm recently launched the AI Pilot U.S. Large Cap Dynamic Beta and Income ETF, and that ticker is AIDB. How does the fund work, and what types of investments does it hold?
So for the AIDB, the QRAFT AI Pilot US Large Cap Dynamic Beta and Income ETF, we are applying the AI to trying to find the potential downside risk for the next 1 week time period. So every Friday after market close, our AI model is working and trying to identify the probability of what will be going to happening for the next 1 week of time. And so this ETF is going to dynamically adjusting its exposure from the US S&P 500 large cap exposure and between the cash and income generative in the asset classes. So long story short, our ETF is trying to deliver an investment solution, not only just buy and hold, but adding up the buy and hold or hedging if it needed in a systematic approach of the utilizing a prediction power of the artificial intelligence.
So then how do you envision this fund being utilized by investors and financial advisors?
So far, the new ETF AIDB has been quite welcomed by the many of RIAs or the retail investors type because we have been covering a lot, enormous coverage from U.S. medias of the welcoming new breed of ETF is entering to the NYSE ETF market, and I believe our new ETF, the AIDB, can be a practical solution for those who are looking for a systematic approach of the protecting their portfolio from the downside risk. Because there has been several attempts in the market, but only using the technical indicator or the VIX indicator only. But the ETF utilizing over 70 different input data and training our model to detect a downside, the risk probability, and which we believe could be a much more innovative and the sustainable solution for the investor. And one more thing is this ETF, even though we just launched last week, but solution we've been developing for protecting the downside risk control. Our company has been providing this solution since 2019 for the many of the financial institutions around the globe.
Francis Gisock joining us all the way from Hong Kong. Thank you so much for sharing more about your ETF today.
Thank you very much.
Stubbornly high inflation has lifted commodity prices. It has also boosted interest by investors on how to gain exposure to commodities. Well, here to discuss investing in commodities and a new ETF targeting the group is Brian Kelleher, Chief Revenue Officer at Simplify Asset Management. Hi, Brian. It's good to have you with us.
Hi, Stephanie. Thank you for having me.
So lately it seems like commodities are the Rodney Dangerfield of investments. It simply can't get any respect. And I'm not going to do my Rodney Dangerfield impression. Maybe you could do it better. That could be changing, though, with the recent upswing in both inflation and the prices of commodities. Break it down for us. How do you see things?
Yeah, listen, that's a great characterization, and candidly, any interview that starts with a Rodney Dangerfield quote is pretty solid. But with the inflation that you're seeing now, it's commodities are definitely back on people's radar screens, and inflation doesn't seem like it's going anywhere. It's very sticky, and it may be around for a prolonged period. But one of the real reasons that you want to look at commodities as a long-term investment really has to do with some of the diversification benefits that commodities as an asset class can provide. So since 1989, the correlation of the GSCI commodities index versus the S&P equities is actually 0.13, so very low correlation. So a lot of benefits to adding commodities into a portfolio, and when you look at bonds, it's even more attractive. It's actually negatively correlated. So again, since 1989, GSCI has had a negative 0.16% correlation to the aggregate index. So the rise of inflation, those correlation benefits, people are looking at commodities again for the first time in a very long time. And the Dangerfield comment actually highlights some of the challenges that investing in commodities can provide. Long term, investing in commodities has been relatively attractive. So from 1959 to 2004, commodities provided a pretty similar return to equities, but did it with a lower return profile. But they can go through periods of pretty prolonged performance droughts. And you've really seen that since 2004, when inflation has been pretty muted, and therefore the returns for commodities as an asset class have been muted. But with the uptick of inflation, with some of the diversification benefits that commodities can provide, and this is something you saw last year, right? Equity markets sold off, bond markets sold off, that 60-40 portfolio that so many people have depended upon sold off. So for the investors that had exposure to commodities in their portfolio, they benefited greatly and really appreciated having commodities in a portfolio.
So your firm has expanded into the ETF market with the launch of the Simplify Commodities Strategy No K1 ETF. I'll have you talk about that. The ticker is HARD, H-A-R-D. Unlike index-linked products, HARD takes an active approach to investing commodities. So break this all down for us, the No K1 and the active management.
Yeah, the no K1 is really straightforward. Everyone hates K1s, right? So what we want to do is make sure that we have an investment that provides access to commodities with no K1. And what we've done with HARD is Simplify has partnered with a company called Altus Partners. And Altus is a commodity trading advisor with over 2 decades of experience investing in these markets. And we've provided a way to get exposure to commodities in an actively managed way, fully transparent, tradable, in the efficient structure of an ETF. So hard listed at the end of March, the performance out of the gates has been really strong relative to its peer group, and it invests in some of the most liquid U.S. commodities contracts out there. And this is everything from oil to natural gas to copper, gold, silver, even some of the softs like corn and wheat and other contracts. And what we do is employ a trend focus that will allocate towards commodities that have a higher expected return going forward, and actually allocate against some of the commodities contracts that have poorer fundamentals or maybe suffering from negative contango, negative roll yields, which is a problem with some of the index-based strategies out there. Some of the other challenges that we're looking to solve for is by taking that actively managed approach, we're looking to provide an exposure that will perform in different markets, right? So not just markets that perform well, like the inflationary period we're in, but where you're having more muted performance in commodities. So being able to actively allocate to strategy to different contracts that may perform better. And then lastly, we want to maintain the correlation benefit. So one of the things that we do is we employ a risk-based allocation process. So we're changing the exposure and making sure that when there's higher volatility in those underlying markets and higher volatility in equity markets, we're allocating out of the riskier assets, particularly in those kind of extreme market sell-offs. You can see some of those correlation benefits disappear pretty quickly. So we want to make sure that we're maintaining the diversification benefits that commodities provide versus equities.
Quickly, before we go, how do you see advisors and investors using HARD inside a diversified portfolio?
Really anyone that can benefit from diversification, which is everyone. So commodities, they offer the historical attractive returns and correlation statistics. They perform well in inflationary environments. So this is really something that really everyone can add to portfolios. So by having this trend focus, having this active risk management process, we're looking to make sure that we're providing an investment to investors that they can hold for the long term. Right, so thinking about how this fits into a portfolio, there's been numerous studies out there from the World Bank, the National Bureau of Economic Research, that indicate that a 10% allocation out of a 60-40 portfolio, again, which is equity and bonds, can improve risk-adjusted returns. So we've got some great content on this. We're getting ready to release a case study with Altus over the next week or two that highlights some of the benefits of investing in commodities. You can find it at our website at simplify.us. So, it's a new fund, but HARD, like Rodney Dangerfield eventually got his respect. HARD, we think, is going to earn its respect and earn its assets under management.
Bringing the respect back. Brian, thank you so much for joining us. It's great to have you.
Great. Thank you so much, Stephanie.
And that does it for today's episode of First Look ETF. If you enjoyed this show, tell us in the comments section below and by hitting the like button. A big thanks to all of our guests, along with Douglas Yones at the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thanks so much for watching. We'll see you next time.